Hey everyone, welcome back. Oh, wow. Okay, we got the Federal Reserve decision for a 25 BP hike, widely expected, coming out within the next 3 minutes. Keep in mind that the biggest things that we're going to be looking for going into this press conference, which airs in about 33 minutes, the biggest thing we're looking for from Jerome Powell, which we might get some hints from the statement in 3 minutes as well. Biggest thing is, what is their read on whether or not we're getting this recession or not? Where is this crazy elusive recession? Because this GDP, the GDP numbers, when we actually look at consumption, aren't that bad. Sure, we've got inventories that have built up, which are leading to a little bit less growth year over year, leading to that lower GDP read on the headline. When we look into the details, the economy still seems to be firing, or as Starbucks literally said this in their earnings call. Okay, I'm not making it up. The economy is brewing on all cylinders. Anyway, the jobs numbers we got this morning, the ADP report reiterate this. Inflation is trending down. Quits are down. Yeah, we've got the insulative blanket of the jolts going down. It's gone down 3 reports in a row, but that's the point. Jerome Powell has said for like a year, he wants the jolts report to get back in line. I remember a year ago, I'm sitting in Canada. I think it was the May or June meeting. We're in May already. A year ago, I'm sitting and listening to Jerome Powell, and I'm talking about how Jerome Powell says, we got to get to a 1-to-1 ratio for the job openings level to be in a more balanced economy. We're still not even close to that, which is insulative. Now, I know some people say, but those job openings are all low-wage jobs. Really? Did you read the ADP report? Because you're still getting hiring in finance and information and these other segments, to the point where we're not seeing these massive job losses that aligned with all of the layoffs that we're seeing. Now, again, maybe lagging information. Totally fair. But the trend seems to be in the opposite direction. So I'm curious to see what the Fed sees. If the Fed sees a strong economy, buckle up, because they're really going to talk dirty to us. They're going to talk hawkish to us. And we don't really want them to hawk to us, because it's just going to make stonks go down. We want them to be soft and pleasant. Like, yeah. Maybe we could even start getting some hints that maybe they're going to cut soon. I highly doubt that. Don't place bets on them talking about cutting anytime soon. Highly, highly doubt that. So do keep in mind, we got about 30 seconds to go. I want you to know that this banner right here, how to make more money and get SH9T done faster, is a free expansion to the Elite Hustlers course for all existing members of that. If you want to get in before we actually raise the price for the AI segment, so that way, because we're adding so much value, make sure you get in by Friday, Cinco de Mayo, 11:59 p.m. And then we're going to do a big price increase because we're adding all these AI productivity segments, and they're great. Here we go. Fed decision is 25 BP as expected. Everything in line as expected with the 25 BP. We got the 25. Now we're waiting for the statement, and then we're going to get Jerome Powell. So statement is not out yet, but will be out within the next seconds here. Waiting for that after that 25 basis point hike, widely expected, highly, highly publicized. And remember, the Fed isn't trying to shock anyone here. They're trying to clearly signal what's going on. Okay, here come the comments. So the comments say, Fed omits prior language that signaled more hikes ahead. There you go. Omitting language that more hikes are coming. The extent at which more firming is needed hinges on the economy. The federal funds rate has now at long last returned to the level it was before the global financial crisis. Still waiting for there it is. Okay, the PDF is out. Just got it. I'm already reading some of the notes here. Key takeaways. FOMC raises 25 basis points. Some additional policy firming may be warranted. That does signal a potential pause at the next meeting. We widely anticipated that. Remember, if you have not yet marked on your calendar, you want to mark on your calendar the next CPI releases, which are in 1 week from today, May 10th. And then you're going to have jobs data coming out May 5th, 5:30 a.m. I'll be live streaming for both of those. And then, of course, June 13th is your next CPI set, which is right before we get the Fed and the next summary of economic projections. We are not getting an SEP today, no summary of economic projections today, but we will be getting Jerome Powell's press conference. Quantitative tightening will continue on pace, also as expected. Stocks now edging higher. liking the headline about omitting language signaling more rate hikes ahead. Oh, duh. All right, let's see. Economic activity expanded at a modest pace in the first quarter. Job gains have been robust in recent months. No doubt. Remember, that's your insulation of this economy. It doesn't matter how many people get fired as long as they have another job to go to. The vote was unanimous. That's interesting. We were actually expecting Goolsbee to dissent. So we had a unanimous vote here. Inflation remains elevated. In other words, their work remains to be done. This is all consistent with higher for longer. U.S. banking, sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, inflation. However, the extent of those remains unknown. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long term. We know this. They raised rates 25 BP in determining the extent to which additional firming may be appropriate to return to 2% over time. The committee will take into account cumulative tightening, the lags at which monetary policy affects the economy, and financial developments. Okay. In addition, the committee will reduce its holdings as scheduled. This is actually a pretty short note here. Let me see if I can get it looks like I'm looking for the strike-through version. I'll have that up in a moment here. But while we wait for the strike-through version, specifically the line, strike-through version isn't available yet. The additional policy firming line is gone. That is the that's the line that a lot of people have been looking at. And that FOMC statement is gone, which is good. It is basically a way of saying, hey, maybe we don't need to hike anymore. Maybe we are done. And let's see. Oh, there we go. It's almost as if right on cue of me complaining about where the strike through is, the strike through came through. I'll pull that up on screen in just a moment as it loads here. Everything loads a little slower on this. Okay, there we go. But this is actually important for you to see. Okay, strike through. And in 5 seconds, we will be live with strike through. Boom. Recent indicators point to have been removed. Instead, they changed it to economic activity expanded at a modest pace. And a growth. Recent indicators point to modest growth is what they previously had. Now they're saying economic activity expanded at a modest pace. Okay, modest growth, modest pace, that's roughly the same. Spending and production, that's gone. Maybe because production isn't growing as well. Job gains have been robust. Okay, fine. Recent developments are likely to result in tighter credit conditions. Tighter credit conditions are likely to weigh on. Oh, so that's interesting. In the second line, they've basically moved from we're probably going to see tighter credit conditions to we see tighter credit conditions. That's an interesting adjustment. Okay, I like that. That's good to know. In determining the extent, here it is, to which additional policy firming may be appropriate. Here, this is the part they got rid of. In order to attain a stance that is sufficiently restrictive. That's a good line to get rid of. In other words, they are sufficiently restrictive. That is fantastic. That is a fantastic delete right here because they're basically saying, hey, we think this 5.125, which is the mid-range. Remember, when you hear what the rate is that the Fed has, it's a range. The range we are at now is 5 to 5.25%, which actually means your effective Fed funds rate is actually about 5 1/8, which looks like 5.125. Anyway. In order to attain, so we've attained now sufficiently restrictive. That's good. In determining the extent of future increases, that's also been removed. So no comment about future increases. That's good. We're at sufficiently restrictive. This is a very reasonable level to pause. So now the expectation is that Jerome Powell is going to talk to us. Generally, what happens with stocks with the Fed day is stocks run into the Fed meeting or the Fed release. Then we get the statement and you get like a little bit of volatility. And then we usually get this weird like U where like stocks fall up to when Jerome Powell talks. They go up and then you get some volatility once he starts talking, and then you get digestion mode. Digestion mode is like 70% of the time positive. So 70% chance we're going to end the day positive. But 30% of the time it ends up being negative. What it ends up being totally depends on how Jerome Powell acts. Is he going to say, hey, look, employment's still strong. Core inflation isn't rolling over yet for services. We're just going to, we're going to stay here for 2 years. I guarantee you if he gives us any kind of indication that we're going to stay at 5.25, 5 to 5.25 for a year or 2 years, the market's going to freak because the market right now is still pricing in cuts. Now we're 23 minutes away from Jerome Powell's testimony, but these cuts that are being priced in right now are just nutty. Actually, the world interest rate probability chart looks nutty right now. My God, I'll show you this chart in just a moment here. Let me get some dust on me. We were working some more on the AI segment for that new course this morning. It's going to be really good. Like if you want to know all about the productivity tools that I use, like they're mind-blowing productivity tools. And it's not just like, here's a list of tools. It's like, how does Kevin actually use it? Who was it? Sequoia Capital had a really great quote this morning. They said, you should not be afraid of AI taking your job. You should be afraid of a human using AI taking your job. That was such a great line. And this is why, we are going to be doing a huge productivity segment in that revamped course link down below called How to Make More Money and Get SH9T Done Faster. Great program. You're going to love it. Best price guaranteed too. So check that out. Link down below. Okay, so what do we got here? So this is the world interest rate probability chart. And basically what this chart here says is we're done with hikes, right? We already know that. The implied policy path is basically created by the bond market's anticipation of what is going to happen with rates. And if we take a little arrow here, we could see what the market kind of assumes. So let's take this little arrow here. This is approximately where we sit now, around here. And the expectation is there are no more hikes, no more rate increases. So what you have here are anticipation, or is an anticipation, that the market is already pricing in, I would call this roughly stability over here, possibly a cut, but roughly stability in July. We have a June meeting here. So let's call the left arrow where we are now, the second arrow here, June. This is July. So the first cut is being priced for July. And then we're looking at as much as somewhere around potentially 3.5 cuts, bringing us all the way down to about 4.25% by January 31st. Typically, people refer to the end of the year when it comes to the Fed as January. So if that seems confusing, that's why. Now, some of the comments here are, how long does inflation need to be below 2%? To convince Jerome Powell? The question so much isn't how long do we need to be below 2%. The question is, we want to average 2%, right? So the first decade, 2010 to 2020, if we're sitting at 1.7 on average, maybe we sit at 2.3 for the next decade on average. But that's going to really take inflation dropping quite a bit here to actually get that average, unless, of course, you want to go out and use a 15-year average on each side or a 20-year average on each side. But see, that's another trick that Jerome Powell has on his tool belt. Like everybody keeps talking about this idea that, oh, the Fed's not at 2%. Maybe they should just raise the inflation target to 3%. The inflation target may as well be 3%. It doesn't really matter. Because if you say, well, we want an average of 2% or we want 3%, that could basically be the same thing. So that flexibility is indoctrinated in a policy known as flexible average inflation targeting. It's a 2019, right before the pandemic, policy that the Federal Reserve instituted. One of the reasons they actually instituted the policy was because inflation was running so low. Inflation was basically running so low that they're like, well, should we reduce the policy, like the projected inflation rate? Should we say instead of targeting 2%, should we target 1.75? And they said, you know what, let's just leave it at 2%. And call it an average of 2%. So now we're dealing with basically the flip side of that, right? Inflation that's higher. Now, I don't think that as long as we have progress in inflation, the Fed needs to rush this down. As long as there's a trend of inflation going down and expectations are not breaking loose, right? That's probably the most critical part. Let's look at the 5-year break even. We should start getting an update here on the 5-year break even pricing, actually in about 3 minutes. But going into this data release, the 5-year break even is at the almost the lowest point it's been in the last year, which is really good. It's sitting at 2.19. This is fantastic. Very anchored inflation expectations for the bond market. So the bond market's not seeing any kind of runaway inflation. You can see that on screen now. The problem is you have the consumer sentiment survey, which is indicating some potential pickup in inflation. But I'll tell you, one thing that sort of offsets the pain of this consumer expectation of inflation that we're seeing is, and I'm not trying to pat myself on the back, I've just been saying it for months, this whole like, oh, oil's going to go to $100 a barrel thing again. Total bull, SH19. Like total bull. Okay. But not only is it total bull, I mean, zoom it. Look at what the oil is doing today. Look at this, folks. Brent, your international blend, and I get this question all the time, so sorry if it sounds redundant. Brent is your international blend of oil. It's a little bit more expensive than the WTI blend, which is the left one on CNBC. Both of these are down 3.5% to 4% right now. Brent's at 72.50. 72.50, I'm pretty sure that's lower than before the OPEC hike. Yeah, it is. Look at this. Go to the last 6 months. So OPEC cut production over here. It was right around the end of the month, right? We got this big boost. We were at like $82 or something like that. Even before that, we were down to 72.97. Shot all the way up to 87, and now we're at 72.56. I mean, oil's plummeting. This is fantastic, by the way. The downside, I will say there is a downside here. So this right here, this whole segment will get cut into thirds. Now, that's really important because when they do the CPI read, they're going to divide the entire month of April into thirds. And then they're going to evaluate, okay, how much basically did energy contribute to inflation? And I hate to say it, but most of this third over here, like if this is one third would be roughly about here to the left. That's obviously way higher. This would be about the next third. That's pretty high. And unfortunately, you didn't really get the full plummet until you were already in May. So this April report on headline could still have one last headline bump in terms of CPI outcomes for headline, at least non-core, but it's going to plummet in May, especially if oil keeps falling in May like it is now. In fact, what we should do is let's look at the CPI projections going forward, because CPI is going to be next week. Very important. I also want you, oh yeah, here we go. Okay. So CPI. So the projection right now for headline month over month is 0.4. That compares to a prior of 0.1. A lot of that is going to be because of energy I just showed you. Core, however, will go down is the projection from 0.4 to 0.3. That's good. Year over year will actually be flat at 5%. And core will go from 5.6 to 5.4. That's the projection, right? So you're going to still have a little bit of a sticky, sort of lukewarm inflation report here for April coming out 1 week from today. And then, of course, 1 day before the Fed meeting in June, we'll get the next CPI report. Very interesting. Deeps here says oil is hitting resistance today. And yeah, gas prices have been rising, ironically, but that could be a temporary sort of a production issue. I think they will come down in time. But yeah, you're right about that with oil and resistance. And so we'll see. I mean, if we break through this, it would be pretty bearish for oil, but bullish for inflation. You have to remember, everybody keeps talking about how, oh, well, they extract inflation from core services. It's total bull, SH9T. Because think about it. If your Uber driver has to spend more money on gas, they have to get compensated more. Same thing for your lawyers, your accountants, your real estate agents, everyone, the people cutting your hair, everyone who uses energy ends up charging you more or less based on their costs because they have to. Otherwise, it doesn't make sense to open the doors. So this idea that we can somehow strip energy costs from inflation is nonsense. Yeah, if you're looking for a bundle code or a coupon code to make sure you could get in this AI group, I see your comment here, Red Bill. Just go send an email to kevin@meetkevin.com and just ask McKay to help you out. He's standing by. He'll help you out. We've been getting a ton of emails. We've been getting blown up with people buying this because it actually, we're really excited about it. The productivity that we're going to be able to teach you about is insane in this. And the cool thing about this is we will grow it as AI grows. So, which I'm very excited about, because obviously, you know, in 2 months from now, there's going to be a bunch of new stuff and we're going to incorporate that in this. And this is not like some technical crap where I'm going to teach you about like neural nets. Okay. I'm not an engineer. This is all about, I'm a business dude. How can this crap make you more money? Bottom line. That's what this is about. Bottom line. How can you use AI to make you more money? That's it. It's simple. So, okay, so we looked at the CPI. Remember that the jobs data that's coming out is the current estimate's actually 182. I thought it was 186 this morning. Maybe it adjusted down a little bit. But non-farm payroll is expected to be 182. If we get something like the ADP report this morning, I think the economy, the stock market could actually do very well. Because remember what the stock market is concerned about now. The stock market seems convinced that we're going to see inflation come down. But the problem is, are we going to see it without a recession? What's Elizabeth Warren saying? Hold on a second here.
Problems we have that have been driving prices higher are not all problems that you can fix by raising interest rates. You know, we have a war in Ukraine that messes up supply chain and energy costs and food costs. We've had a lot of price gouging that giant corporations don't want to talk about, but families are sure feeling it. And you can raise interest rates, but it's not going to affect those. You've got other tools you have to work. We've had supply chain.
I mean, it's true. It's a blunt knife is what it's described as, right? It's like, hey, we raise interest rates. How does that affect lower income people? It doesn't. You know, their credit card rates going up a little bit doesn't make a difference. It affects people with assets. Now, I want to say regarding the Meet Kevin report, okay, important update here. This is an idea. I've been evaluating this. I'm not sure I'm going to do this, but just to be transparent, I have an idea. Rather than doing like these long, like 1 to 2 hour Meet Kevin reports in the morning, I'm considering doing like a condensed 20-minute Meet Kevin report. And then that information will be unique. You know, I won't be reposting it later in the day. And then we'll go into what I'm thinking will be a little bit of an earlier course member live stream. And then we'll go deep on fundamentals like we do every day in the course member live streams. Every course member gets access to. And then we'll, you know, maybe have like a single topic video. I might try that. I'm not sure. But that's something that I'm thinking about. So I love the Meet Kevin report. Don't get me wrong. And it's top of mind for me. And I'm trying to figure out the best thing to do with it. But the performance wasn't ideal the way it was working last time around. But anyway, let's continue listening here for a moment.
Interest rates and lowers interest rates. I mean, basically. So they look at the world through that lens. But look at the effect of price gouging, for example. And the data, depending on who you want to read and what you want to look at, but at least 40% of the increase in prices attributed to price gouging. That is, look at industries where there's greater concentration.
Yeah, I actually highly doubt that this is price gouging, 40% of it. I mean, don't get me wrong. Corporations are raising prices, and they're doing it because they can, but they're doing it to preserve their margins. But that's what a corporation's supposed to do. Otherwise, they go bankrupt, you know? So I don't know if that's gouging. And what's your definition of gouging?
Even they should have done. And to squeeze out what inflation remains, you would look at what legislation to address price gouging?
Legislation could be part of it, but the FTC is part of it, the Attorney General. We have laws in place that give us some.
I think she just made that up.
I'd like to see us do more. That would be the legislation part. States also have anti-price gouging laws, and they can bring those to bear. Partly, you can use jawbone on it too. The chairman of the Fed, the president of the United States, can talk about these industries with specificity about who's in there pushing prices up more than is justified by an increase.
All right, Warren, whatever. So let me just read off some of the other updates we got here. U.S. macro strategist statement rhymes back to 2006. They never flat out said they're done, but this was as close as they could have come. Nobody wants to compare to 2006. Nobody. Because 2006, is 2 years basically before the real bottom of the pain. Okay, somebody wants me to run a poll while we wait for Jerome Powell in 8 minutes. Jerome Powell will be live. I'll run the poll. For Meet Kevin report, what do you prefer? Long MKR, short MKR, no Meet Kevin report, no MKR, yeah, Meet Kevin report. This is a little skewed because obviously y'all are here on a live stream. But anyway, did the terminal rate increase? Let me see. I will tell you. Projections for terminal rate. Let's see. Okay, that poll is live now, by the way, if you wanted to look at that poll. Projections for terminal rate are... Thought it would have loaded by after the 5.08. So the market's pricing of the terminal rate is actually lower than we are right now. But it's basically saying we're at peak, which seems appropriate. 5-year break even, pretty stable at about 2.2, which is good. We're looking at another key economic moment this week. It comes with the Fed's labor report on Friday. Remember, I'll be covering that live. That's on Cinco de Mayo. We'll be covering the jobs report live, 5:30 a.m. So come for that live stream. A Harvard economist and former NEC chairperson, Jason Furman, says forward guidance is over. Well, it'll be interesting to see how he handles the press conference. I agree, because that's what we're all looking for right now in this press conference that starts in 6 minutes here. Let's see. Yeah, well, this press conference will be fascinating because again, so let's write down some things that we're going to look at. Okay, I think that's a good idea. So what are we looking for? So what we need to know. I really need to get my keyboard for this. Whatever. So what do we want to know? Let's write down some ideas here and shout out some ideas in the chat as well. What you think. So what do we need to know for the miss? Well, what we want to know is, any kind of GDP growth. Are we closer or further to a soft landing? From soft landing. Probably a big thing would be response to inflation expectations rising per U of M. That's a big one. I don't know if we'll actually get a response on that. There's been some stability in housing. Does that suggest in housing, in some cases, prices have been going up? Does that suggest higher rates? Could, higher rates in future, like mid-90s when they paused and then hiked again? So a reference to the mid-90s would be worth knowing. Although that would be sort of contra to what we've seen in the 70s, which is where they had that start-stop mentality. They don't want to do that. So interesting. Yeah, the poll does not help at all. Out of 1,700 votes, I'll let people keep voting. Poll's worthless. Okay. That is a funny result. Okay, so what else do we want? We want what about how any kind of fate, obviously, flexible average inflation targeting, but also how long will they be patient? Right? Like what's the rush? Obviously, which I doubt we're going to get, obviously hints for cuts or talk of cuts. I doubt we're going to get that. Doubt we'll see. So you've got about 75 BP priced in, cuts priced for December, and about 100 BP priced for Jan. Obviously, some banking crisis nonsense. We'll maybe get a little bit of that. The AI segment will only be in the how to make more money and get SH9T course right now. That's it. But that's a free upgrade for all of those existing members. I want to give back to those existing course members and that's also a really phenomenal course. It's different from the investing ones like real estate investing or otherwise. Okay, so perhaps a little bit of a surprise is the language on the job market didn't change. We thought some tweak was in order. Job gains have been robust. Well, why? I mean, that's accurate. I don't think a tweak was necessary there. So, okay, good. So we are now through 2 minutes away from Jerome Powell. Let's listen in here for a moment.
This very afternoon, instead of holding a press conference, Jerome Powell should be tightening down those regulations at the Fed where they have the discretion to do that. And then part three.
Oh, come on, Elizabeth Warren. Oh, Jerome Powell shouldn't be holding his press conference. All I hear is this. It's just like a manipulate you.
Those banks stable.
Let's talk a little bit about a topic that we touched on the last time you and I were together, and that is stock holdings and investments of members of Congress.
Yes.
What progress, if any, has been made on that front? And I note that you personally do not have individual stock holdings.
Nope.
You have funds and
mutual funds.
Like that.
That's right. That's it for me.
So what's happened and what's left to do? A lot.
So you want to talk about something that's hard, trying to get members of Congress who will all say in general that they think I shouldn't even say they all say it. Some will say there's a problem with stock trading. But look, I've been in
this is boring. Okay, listen, we are 60 seconds away from Jerome Powell. We'll be listening in obviously live here. No changes yet in the expectations for the future course of rates. We are on standby to see how markets react to every waking word Jay Powell says. We'll be listening very closely. If there's something that I think is urgent, obviously we'll point it out. What button? I don't know that we need any of these real buttons. What buttons are these again? Sell. So we got a gym one.
Betrayal.
That's a good one.
Betrayal.
Anyway, 20 seconds from Jay Powell's meeting here. We've got right now the Dow sitting at up 14 basis points, S&P up 0.43, so 43 basis points. You're at 83 on NASDAQ. Russell moving the most at about 1.5. What's she yelling about?
Or not? Would you raise deposit insurance payroll cut?
Look, right now we have unlimited deposit insurance. Come on. Everybody knows it. Only the difference is the big banks and the big depositors that are taking advantage of it aren't paying a penny for it. We need to raise it and make the people who take advantage of it pay for it.
This is all hurting small banks more than anything.
Absolutely.
Banks, because they're now going to have to pay into these. And because
if you have existing courses, just send an email to McKay. Just send it to kevin@meetkevin.com and we'll get you bundled up.
Subsidizing the big banks.
They want the insurance raised. They say that's how you level the playing field. We can compete with the big guys if you'll raise that cap for us. Would you do that?
Absolutely.
Where's Jay Powell?
I've got one.
There he is.
Here, and there is Chair Powell. Senator Warren, thank you so much for being with us. We appreciate your time.
Gain the lead.
Here is Jay Powell.
Gain the lead.
Turn your mic on.
Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week, we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. Unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters,
Really?
as well as measures from financial markets.
Okay.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, neutral to me. That's fine. Totally fine. I was surprised by the U of
Hi,
M. He
Gina
didn't mention the
Smilik,
U of
New
M.
York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June.
I mean, that's obvious.
And I also wonder if
There's Nick T.
the Fed staff has in any way
Right there on
revised
the
their
right.
forecast for a mild
got a
recession
scratch.
from the March minutes. And if so, what a recession, like what they're envisioning, would look and feel like when it comes to, for example, the unemployment rate.
Good questions. Good questions.
So taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence
wait
that
to
said
CPI.
the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting.
Fair.
So the staff's forecast is so.
4-6.
Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa.
Oh my God.
The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Okay, 4-6. 1% rise in unemployment.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions.
Okay.
I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters for starters, and they're for Congress and the administration, for the elected parts of the government to deal with and
Leave it to the Post to waste a
really
question.
consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite adverse. So
All right, next.
I'll just leave it there. We
Yes.
don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision?
No.
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision.
Duh. Sorry. Stupid question. Pissed me off.
Oh, thank you. Steve Leisman, CNBC.
He's good.
Tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks. And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't, it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing. And I thought it was a good presentation. And as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately it has its limits. I mean, I think in this particular case, we have found that monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
All right, next. By the way, McKay's getting inundated
I don't
with
mean to be
emails.
argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case that I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things and we're on the case.
He's talking about a report the Fed released, basically pointing out, yeah, there were failures. It's a review report. I'll pull it up.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks. And I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of
Globally,
banks doing different
systemically
things.
important banks.
I think that's a positive thing. Is it a financial? So I would just say in terms of JP Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role. So I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate. And I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's
That's
actually
true. There was an exception made, a legal exception.
It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Okay. Next.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that in a sense restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong, then if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way.
Find ourselves?
The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that they're listed in the statement, the obvious factors. That's the way we're going to be thinking about it, that's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds to uncertainty. What's happening with credit conditions? What's happening with lending? There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Yeah, he did say
Howard
that.
Schneider with Reuters. Thank you.
So
noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made as that would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting. And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLOOS survey indicated?
Senior Loan Officer Survey.
I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Nick Tamaros, Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And, that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing.
2 CPI reports.
We have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
That was a good line. He went off the rant right there. That was a good one. That's good. That was the pause right there.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
You know what? Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. And I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think
Patience, bro.
they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation
new labor supply
is
coming in?
running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Quick note, McKay sent me a message. He's getting blown up with emails. So send him an email, Kevin@Kevin.com.
So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did.
Dude, that's like the guy who got banned from that Congress.
In their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market. It's interesting as, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession.
Oh,
But
that's a
not-
flip
It's
flop.
not that the case of having a
It was
recession
50-50.
I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above
Here's the
levels that would
speaker.
be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3% roughly is what it would take to be consistent with inflation over a longer period of time.
Oh, okay. We're close then. That's actually close. 3%.
By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Gain the lead.
Great. Christopher Gabriel at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
Okay. All right.
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do
Yes,
you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward, is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. Again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Okay, well, that's fair. Waiting for phase 3. I get it. I'll explain.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks?
Quickly, a quick explanation. He's basically saying, look, our forecast is that as long as services inflation is high, we have to wait. But he basically just told you, as soon as services inflation rolls over, yes, it'd be appropriate to cut rates. That's what he just said. That's bullish.
I think now
this question is bullcrap.
Growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around, things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewall-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Betrayal.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive.
He has read it?
I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. What our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks?
Yes,
And
Nelson,
secondly,
that's correct. Path to Wealth course is the same as the Elite Hustlers. Both, it's all being rebranded now as how to make more money and get SH9T done. That's the AI course and everything. That's all in one.
I guess I would say it this way. There were three large banks really from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, next. Come on.
Thank you, Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to
on bike riding?
Over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy
Some of these questions make me want tequila.
Develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why. And that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors. And really, in supervision, has sole authority over supervision.
Okay. Wow. This is all I heard.
If you had any regrets, or was there anything that decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
All right, let's go. Better questions. Come on. want to get to the summary so I can pitch the AI course again.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously
did
was
you
that
not
considered?
listen?
I'm curious if you can give us any color as to whether there were any initial concerns about raising rates
literally
again, or
said
what those
no.
discussions entailed.
First question.
Support for the 25 basis point rate increase was very strong across the board.
It's unanimous.
I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
Barbara Brett.
Hi, Chair.
All right, last question. Come on, baby.
With Marketplace, you mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Oh my God!
Yeah, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Shut up.
That's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
God. All right, let's summarize this. My God, some of these questions. Jeez, Lord. Okay. Woo. Let's do a summary. You ready for this? I'm actually excited about this. It's actually pretty good. We'll start with the juicy stuff. What is it? Who's sending me a message? More bundle emails. Okay. Send me a screenshot of a bunch of bundle emails in 3-minute time span. All right. Okay, here we go. Well, it's been a while since we've done one of these. Well, Jay Powell is back at it again, dishing out some information about recession or no recession, and when are those rate cuts going to come? Because he certainly didn't want to imply that those would come today. But then again, nobody had the expectation that Jerome Powell was going to talk about, oh yeah, we're going to cut. Because as soon as he does that, everybody and their mommy and their grandmommy are going to go out and borrow money again and go spend, because all the pain will be over. And that'll ruin the whole fight they're doing. So, of course, he's got to tell you, no talk about cutting rates yet. But he did actually establish the perfect framework for when we will know that rate cuts are coming or not. He said it. If you were listening closely, you heard it. Let me break it down for you, though. Here's exactly what he said. We have a view that inflation is going to come down not so quickly. Those are really important words. Not so quickly. If that forecast is right, it would be inappropriate to cut. Okay, now we need to distill that. What he basically said is, if inflation teeters and lingers and inflation's sticky, especially in the ex-housing services like haircuts, CPAs, Uber, all that kind of stuff, right? Your personal services stuff, right? If inflation stays sticky there, then of course we can't cut yet. But we've known that. However, what is the inverse? If we see a drop in services inflation ex-housing, then maybe the market's pricing of rate cuts could be appropriate. But when would we know if that's appropriate? Well, he actually told us that as well. And I thought this was really interesting because he essentially guided and suggested via the following what will happen and when the data will come. He said, quote, "A few months of data will convince you that we've got it right." Oh, now in my opinion, that was actually bullish because he basically told you, hey, look, we just need a few more months of data and then we'll know our forecast is right or it's wrong. If inflation comes down slowly, we have to keep rates higher for longer. If inflation comes down quickly, especially on services, which we'll know within a few months of data, then we can cut rates. That's basically what he said, which is phenomenal because guess what we have between now and the next summary of economic projections? Lots of data. Remember the data dates you want to write down. Number 1, Friday, we get a jobs report. If it's anything like today's GDP report, it means no recession because jobs are still flowing in like crazy. Today's GDP report, today's ADP report. ADP report came in massively strong. But what else do we have in terms of dates? Well, at the end of the day on Friday, we're raising the price on the Elite Hustlers course, which is now rebranded as the AI Productivity course. How to make more money and get SH9T done faster. We'll be releasing the AI segment on June 1st. We're really excited to release that. All of that AI content we're producing right now, Blackboard lectures, everything, it's all coming out on June 1st. So that'll be really cool. But we're going to raise the price on Cinco de Mayo. So we're doing a little pre-sale for that. So check that out. May 10th, CPI at 5:30 a.m. And then, of course, June 13th, 5:30 a.m. CPI. And then we'll have the next Fed meeting on June 14th already. So that's in about 6 weeks. We'll see Jerome Powell again. We'll be sitting here again doing the same thing. But he gave us a very clear guide. I thought this was actually really impressive. The fact that he said the following in a row, a few months of data will convince you we've got it right, that they're potentially where they need to be with rates. And then do they have to stay or drop rates? Or in the edge case, raise rates. That's actually really good. He was very, very clear about this. He suggested that housing remains weak. They did not talk about pausing today, but they did talk about pausing in the future. It's likely that June meeting is going to represent a pause as long as inflation continues to trend down. Given that oil prices are plummeting, especially even after the OPEC plus production cuts, which initially led prices to rise, now they're falling. As long as those oil prices keep coming down, you could actually see services fall down with it, which is fantastic. Jerome Powell also indicated that wage inflation sits at about 4 to 4.5% right now, and you want that to be at about 3% to actually indicate 2% inflation. Now that was interesting. So you want wage inflation at 3 to have 2% inflation. Hadn't heard that one before, so that's a good one. What else did we get? So the big thing, obviously, on cuts, the market went a little sad initially after that because it seemed like maybe he would tell us rate cuts are coming. But again, that would be wild. He indicated that inflation expectations were still well anchored, which I thought was surprising because we started seeing inflation expectations actually pop up again a little bit on the University of Michigan inflation expectation survey. That may come maybe because of gas prices temporarily having risen. So that might flip-flop back down when gas prices trend back down. Obviously, we got the 25 BP hike we were expecting. The market is pricing in still a substantial amount of cuts. Effective terminal rate right now, the market is pricing in 5.08, which is actually slightly below where we are right now, which suggests we're at peak. When it comes to the actual chart of rate cuts, the market is pricing in the following. Look on screen now, you'll see a chart. No, it's not another course member pitch, although that is going to be a really epic course. You're pricing in 3.5 rate cuts by January 31st, which works out to about 1% of cuts. slightly around 1% of cuts starting about July. So we could still be in that pause situation for June with potentially the first cut, coming as soon as July or August. So the other thing that we really enjoyed, in addition to Jerome Powell's commentary that we might be at the peak right now, was the policy statement. Oops, those are some of my notes. Doesn't matter so much. This right here. This is the policy statement here, right? The policy statement had a removal of the following, quote, in order to attain a stance of monetary policy that is sufficiently restrictive. That line has been removed because we're already at that level of being sufficiently restrictive in the opinion of Jerome Powell. Jerome Powell, in fact, suggested that real rates are at about 2% right now. We're at 5% on rates. 1 year outlooking inflation is about 3%, which means real rates are sitting at about 2%, which is, he believes, at or above the neutral rate plus quantitative tightening, plus the credit conditions tightening from banks, suggests we're either not far off or probably there. We're probably at peak, in other words, which is good. This is around the same peak that we had before the 2008 crash, which is a bummer because we hit that in 2006, which is not a date that we want to relate to. Now, looking at this statement as well, we also removed the line here in determining the extent of future rate increases in the target range. A lot of people had heart palpitations about that last time because, there was an S on the last statement implying we would get multiple more hikes. We did not. We got one, and now we're expecting a pause. We believe that the Fed is also now heavily focused, they said. They said, quote, he literally said, this is our focus. This will be important. Even tighter credit conditions. Our attentiveness here is important, including on small and mid-sized banks. So really focused on the cumulative effects of that credit tightening. Important. Obviously, there's still some more work to be done. However, there are signs that the labor inflation is starting to fall. When we study this in our course member live streams by going through earnings calls or fundamental analysis, we also agree we are not seeing a wage price spiral. Very important. Now, what else that's very interesting is Jerome Powell said something that he actually seemed very proud about, and it had to do with his odds of recession, as well as what's going on with labor. So he suggested that we have not seen before, and history wouldn't tell you, that it was actually possible for job openings to decline without at the same time seeing an increase in the unemployment rate. But he said, well, that's what we're seeing. And that's actually good news. So in other words, usually when job openings go down, at the same time you see the unemployment rate go up. But what's actually happening is job openings are going down into balance, and we're not seeing unemployment go up, and we're not seeing a wage price spiral. That's actually a really good case scenario. And I think that's what led him to say that the case for avoiding a recession is potentially more likely than it was previously. Previously, he suggested the case for avoiding a recession would be about 50-50. And now it seemed like he thought that there was a case for actually avoiding a recession, that a recession might now be potentially less likely. But, there's still the case that we're going to have a recession. But having been 50-50 previously to softening on that, I don't mind that. That's actually pretty good. So I actually liked this press conference. I like that he made it very clear. Like if I was going to explain this to a 10-year-old and they said, so is Jay Powell going to cut rates? He made it very clear. He said, hey man, Jay Powell came up to us and he basically said, yo, look, man, we're just going to hang tight at this level, which is probably good enough, but we want to see what the next couple reports say. Because if the next couple reports come in hot, then we're going to have to do more. But these next two reports could say that, hey, inflation's doing just fine, and maybe then we could start talking about cuts. But until then, we're going to go ride our bike for 6 weeks because why speculate on it when we don't have the data yet? Instead, just wait for the 5th, which is in 2 days for Friday, and then wait for the CPI report in a week from today, and then, of course, the next CPI report thereafter. So overall, this was, in my opinion, very clear Fed report. Comparing this to the expectations we had, we didn't really hear anything in terms of GDP growth other than potentially we have more of a likelihood to avoid a recession. That was good. He suggested that, that's some light into the soft landing. That's good. The higher for longer is pretty consistent, being patient until we actually get the data. And then, of course, it makes sense that there's no way he's going to dive into rate cut talk until we actually have the data to support that, because that would just undo the potential of inflation actually coming down. Because again, people would start spending like drunken sailors again. Now, while we were going through that report, a lot of folks were emailing us, as you should as well, at kevin@meetkevin.com. Oh, Elijah, thank you so much for saying that. Elijah here saying, Kevin's courses are great. I got the real estate and stocks and psychology courses. The real estate course is legendary. The stocks course is pretty great. One of the best investments you can make to start. That's awesome, man. Thanks so much. Yeah, it's important to remember that those are the investing courses, right? And then the how to make money courses have had a few different titles. Originally, it was the Path to Wealth. Then we turned it into the Elite Hustlers. We're retiring those names, and we're just making it a lot simpler of a title. The title is How to Make More Money and Get SH9T Faster, featuring AI. And the AI portion comes out June 1st. So we're really excited about that. If you want to bundle up or you have questions, just send McKay an email, kevin@meetkevin.com. Thanks so much for watching. And I'd say, look, overall, my opinion, good report. Is the market going to be volatile? Of course. Who cares? The Nike swoosh recovery, in my opinion, has been very consistent this year so far. And I think it'll continue. What's going to happen with Open Door tomorrow or some stocks or Bill.com? I have no idea. But fingers crossed you're able to build your wealth over the next few years. Great time to start. And can't wait to launch the House Hack non-accredited. See you soon.